Okay, welcome everybody to this somewhat delayed global economic outlook for 2024. I think it would have happened about a couple of weeks ago, but I unfortunately fell ill. I'm much better now. Some of you privately WhatsApp me to ask if everything's okay. Everything's fine. It was a chronic lower back problem. I'm sure half of the people on this webinar can associate with that, at least statistically. So it's interesting because as I was going through what would have been, I guess, a couple of weeks older presentation, we've since had some updates. We've had sort of new data come through, and it's really fascinating. A little bit like the budget webinar, which hopefully, if you want to, you can download on social media and on Sygnia's website. Gives you slightly longer sort of pause for thought to look back at, okay, what did somebody say at the beginning of the year about the growth outlook, and what does some of the new data suggest? Does it confirm the trends that we're observing, or does it in fact counter what they expected to occur? And you'll begin to see that with some of the data that perhaps has been taken over by more recent projections and so on. So what I'll try and do, hopefully slightly different to the very standard sort of running through global economic outlook numbers, and try and pick up on a few themes that I think are really important as we look to possibly the next 12 months even, so from now until March next year. So I will give you sort of three big areas that I want to focus on. One is what do the GDP forecasts look like globally, as well as some of the key markets, whether it's China and the US and the EU, with a little bit of a twist on emerging markets and where some of the GDP figures are going there. And then to switch to not just the global inflation outlook in terms of product drivers, whether it's goods and services, but also what I think are particular areas of concern for this year, namely shipping costs and oil. And I'll talk to that a little bit, with the following, which I'll look at the financial markets and why we need to focus on financial market developments when you think about inflation. And then perhaps something that hasn't really been featured in thinking about the global economic outlook, certainly in the South African context, is the rise of trade fragmentation and why global trade is struggling. And I'll talk to some of that, and then conclude with both the downside risks, which will fold out from my three-part presentation, as well as the upside opportunities. So let's get into it. And I know that people still signing on, but we'll start anyway. So what I've done here, you often will get a presentation from the house view. So either the particular bank or the particular institution will present their house view on global growth rates or local economy projections. What I've tried to do is at least pick out the three multilaterals that perhaps for our audience, you are less likely to, A, look at their growth rates for, at least this audience, and secondly, even less likely to actually see comparators of. So I've taken the World Bank, the IMF, and the OECD, and I must emphasize their initial growth projections that came out sort of late January, I think it was maybe mid-Feb, for the period 23 to 25. So what does it show? I think the key is for those three models, which subsequently in the spring meetings now the IMF has slightly updated, but they essentially show either a slight dip in growth rates for the world economy, or in the IMF's case, a slight a steadying of growth rates at 3.1%. So you effectively have a flatlining of growth or a decline, depending on the model, across the three major institutional macro models that we see. I think what's really important, again, probably not emphasized enough, we don't take a long-run view often enough, is that this range between 2.4 and 3.1% across the three models. So if you can see my cursor, that's that 2.4 and then the 3.1, and then the OECD comes at 2.7% for global growth rates. is well below the global average for the last decade. So let's take 2000 to 2019, 2 decades period. That global growth rate stood at 3.8%. So you're looking at a range for us now that does not compare favorably to the 2 decade period, let's say pre-COVID. And essentially, it's pervasive across all the major economies. So what you're seeing, apart from a sort of minor uptick in this already sclerotic growth rate in the euro area, you're basically seeing all major economies coming in at much slower growth rates. There is a slight uptick predicted for 2025, but it's not a major upside correction. I ask the question, as do many others, that, if you take the slightly medium-term view, what you're seeing is effectively a 3-year correction to the global economy following a 2-year pandemic. It's important to keep that in mind, right? The 2-year pandemic is not going to be washed away through a sudden sort of 12-month period of growth. And I think you're seeing that coming through the sort of muted global growth projections for this period. And as you see, if you look at the 2025 figures, there isn't sort of a sharp rise. Just as an aside, I don't discuss it in the bullets, but if you look at advanced economies, so let's hold China for now. But if you look at advanced economies, the source of global growth in the advanced economy world is coming from the US, right? So the US at the moment is giving us that drive for global growth. There's very little coming, if anything, from the euro area, and certainly not from Japan. So why this muted global growth apart from the pandemic? Well, if we dig below the pandemic, you've got soft labor markets, so labor markets that are still slack. You've got reduced saving buffers. So people had a lot of disposable income, right, as we emerged from the pandemic, but those have actually now dissipated, right? And that then feeds into a reduction in the demand for services mainly, right? So if you think of the average that had lots of pent-up demand for travel and the like, this has now fallen away as savings buffers have disappeared. You also, as we all know, right, have the lagged effects of monetary tightening, right? So interest rates, yes, we're going to talk about interest rates and the projections going forward in terms of their decline, but they're high, right? And they've been high for a long period. And the effects of that high interest rate cycle working their way through domestic economies around the world are what you're seeing being shown in these growth rates. The other figure it's important to keep in mind, but of course it's effectively the right-hand side variable. One of them that predicts the poor growth rates you see is very low per capita investment growth rates, right? Again, they are averaging those growth rates in investment. If you look at that second last bullet, are projected to grow at 3.7%. What does that figure look like? Well, it's half the average of the previous 2 decades. So let's just, take those sort of almost the second bullet on the top and the second last bullet and put them together. You've effectively got an economy, a world economy, and most advanced and major economies, including emerging markets, that have grown close to 4% over the 2 decades. Let's call it 2000 to just before COVID, right? Now we're in a period, and investment has grown, right, dramatically, right, at let's call it 7.4, make it 7.5%. Now you're in a period where effectively for the next 3 years, and certainly for the next 2 years, we're seeing a collapse in both growth rates relative to those 2 high decades, let's call it, and a collapse in investment. And I think that's an emergence, right, from COVID. And so we're in this period of what we can call a reset, right? And I think if you're looking for an emblematic representation of 2024 and going on to 2025, it's the global resetting, right, of economies, both advanced and emerging market economies. if we take the country level estimates, and this is sort of just a representation of the data and averaging it and so on, it's clear that emerging markets have and always will be growing, at least in the last 2 decades, faster than advanced economies. So I think that's really important to keep in mind. And so what we show there on the far right is where the emerging market average is at about 5%. It's much lower for advanced economies that sit down here. Yes, there's greater risk, volatility, and so on, but just on pure growth rates. But the one thing that's really important, and so let's just look at the relative growth rates. Emerging markets here are growing at least at a median rate 4 times faster than the Euro area and 2.5 times faster than the US, right? So even though the US in the advanced world is the one dominating growth rate for the advanced economies, emerging markets, almost by definition, in terms of the development path of economies, will be growing faster. You may have noticed something very important that's changed. For the first time, I think, for as long as I can remember looking at these statistics, India will be growing faster than China. So let's just pause there. India will be growing faster than China. It's never happened, at least in the last 2 decades, right? And so I think that's something to keep in mind. We'll talk a little bit about demography, although we may not have enough time to go into detail, but I think there are a whole lot of factors, part of which is demography and China's struggles. But I think it's interesting that in the two sort of emerging market titans, the rank ordering of growth rates has now changed. So we look at this and we say, oh gosh, 20 years of sort of a full table, right, of goodies in terms of growth, a full buffet, as it were, and suddenly now we're looking at a very sparse table in terms of offerings, and the growth rates reflect that. What we do have to keep in mind, and I love this quote from the World Bank, and I've taken the direct quote, right, and it's worth reading it for yourself as I talk through it, but you do have to keep a longer run perspective in mind, right? So we've had the fastest increase in interest rates on average across the globe, emerging markets included, for 40 years, right? So the world has never seen for 40 years, 4 decades, this fast an increase in interest rates led by the US. Usually, right, all our macro models should tell us that that's gonna result in significant real economy scars, right? Steep rises in unemployment. If one thinks of the numbers from the Great Financial Crisis as well as the Great Depression, of course, right? There should be massive real economy scarring. And in fact, it's been relatively tepid given the interest rate adjustment. We haven't seen the world economy dipping into significant recession. We've seen what looks like a general clear pathway towards a soft landing. So I think that's the positive I take away from the tepid growth rates that we see. Not everybody agrees. So I've taken the Deutsche Bank, what I call the outlier result, for noting only. The Deutsche Bank, and it'd be interesting to see the updates. I haven't had sight of them since this was produced early in the new year, or I think this may have been even late last year. They were projecting a mild recession for the US in the first half of 2024. They don't provide any of their modeling. I've tried to look at the equations and so on. None of that's available, at least to me. Their US GDP forecast is much lower than most other major models. And a lot of it is to do with their view around the US Fed and the higher for longer modeling projection they have, right? I don't think the Deutsche Bank model result is credible in this particular instance. I have almost half tongue-in-cheek said that even Rabini, who you may know as the NYU macroeconomist who projected and predicted the great financial crisis, even he's positive, right? Mr. Doom, as they call it, or Dr. Doom. His view is that you are going to see a soft landing, right? And there won't be a recession. Now, what's really interesting, and I want you to, for those of discerning listeners who haven't had enough coffee to sort of focus on the details. The quote from Rubini is really interesting in another respect. He has a notion there, which is again from at least 2 months ago, that central banks may start to cut policy rates in the first or the second quarter of this year. So in fact, he was feeding into the market frenzy that we were going to see cuts from the Fed early on in the year. And of course, that hasn't happened, right? So this is what I mean about, okay, well, what did commentators say early in the year? And you do recall, right, from December last year already, we had a frenzy in markets, right? Around the possibility that the Fed would reduce rates, and that hasn't happened. So I think as we go through the presentation, you'll see some of the moderation being borne out by the actual results on inflation and, of course, the US reluctance to reduce interest rates. If you look at specific regions, and I'll go through the US, Euro, China, and emerging markets. The US growth figure is what one of the data points that the Fed is looking at. It was softer in Q4 of last year. There's a view that this was going to intensify, right? As we move into 2024, it hasn't quite happened, right? So we haven't really seen a significant real economy contraction that the Fed would be looking for as a signal that there should be a turning point in interest rate. So that hasn't really occurred yet. But as a representation of an earlier point, we do know that excess savings are gone, right? So with the pandemic spending over, excess savings have dissipated amongst households, and therefore one of the key factors for driving growth has disappeared in the US economy. So what do you want to focus on? So you want to look at the labor market, so payrolls. So you can see for the Fed, people often misunderstand. The Fed wants to see in the current context a rise in in unemployment rates, right? Because that then shows interest rates are having an effect on the real economy, and we're moving towards our natural rate of unemployment, as you recall from previous webinars. That then gives the Fed enough evidence, as it were, to think of reducing interest rates. There are other things that we do need to keep in mind that perhaps haven't been emphasized enough is debt servicing burdens and refinancing pressures for both households and firms, and I'll show that in the next slide, are something to keep an eye on. So I think, and that then relates to the third key domestic factor, which is with this high interest rate environment, there are pockets of stress in key markets, namely regional banks, in particular in the US, commercial real estate as well. So the idea that you've got elevated interest rates have not gone unnoticed in key markets, right? And I think that's something to keep in mind for the US economy in particular. On the wage gains, there's a projection for 2024, right? Because labor markets are still soft, so you do have some slackness in the labor market. Wage gains are likely to be less than they would ordinarily be. On the fixed investment side, which feeds into the lower growth projection, that's not likely to increase dramatically because firms are either sitting with high debt on their balance sheets, or, of course, with the expectation of reduced rates, will hold back until we see that turning point. But again, as new data comes on stream, and the economy being as dynamic as it is, we keep a watchful eye on the US economy and changes therein. I think one of the things that's not going to change are these two pictures. So credit card delinquency rates, so going back to these elevated interest rates, have resulted in a significant increase in subprime, as the US calls it, subprime auto and credit card delinquencies. As you know, for subprime definitions in the US, these are for debt holders who are below a certain credit score, right? So it's low quality debt. But the idea that you've got delinquency rates being elevated and going up, and being projected to go up suggests significant household stress in a certain part of the distribution, right? You've also got fiscal tightening, right? So one of the things that we probably haven't spoken about enough is the federal deficit, right? So if you look at the U.S. economy, deficit to GDP ratios are high, right? And so that means that there isn't enough fiscal space to look at a Keynesian kickstart or expansionary fiscal policy to counter any growth concerns, right? So you effectively in a period of fiscal tightening, and I think that's really important as you look for sources of growth, both in the US and elsewhere. There's an interesting view around housing. That you've got a combination of affordability, right? So if you look at young people looking for housing, prices are extremely elevated because of supply shortages, right? And then if you've got, which is an interesting point, 75% of mortgages in the US are locked in at 4% or below, right? Effectively, right, what that means, if you've got the supply shortage, if you've got affordability metrics at its 40-year low, the US housing market, as one of the commentators put it very well, is effectively in stasis. It's frozen, right? You can't see any way out of it in the current context. However, if you've got projections around reduced interest rates from the Fed, then you're in the JP Morgan view, which is there's a possibility that in the second half of 2024, the US housing market begins to pick up a little bit, right? And that's something to keep an eye on. The one area I have emphasized a lot recently is around US commercial property debt. If you look at the elevated interest rates that have come through, you've got about $550 billion of dollars of maturing commercial real estate debt over the next year, right? And if one looks at revenue streams for this part of the US economy, they do not look, it's not a pretty number, right? And so you're looking at losses possibly in the US commercial property sector. And I think some of the strains are already showing in the listed entities. And this could be a key headwind going forward. Linked to that, right? And we've already seen it last year with one of the smaller regional banks in California. The interest rate environment has come home to roost, and there are remaining challenges for regional banks in the US. The Eurozone has been stagnant for a while, and it will continue in that vein. So if you look at the numbers, the euro area hasn't come to the party in terms of supporting global growth. There is an expectation, right? As you saw in the uplift from, 0.7 to 0.9 in one of the models, right? That you will get slightly stronger household consumption coming through as energy prices from the euro area decline, as supply alternatives are found in the face of the Ukraine war, that may drive some of the recovery. But it's not sufficient, right? You've still got Germany that's struggling. Southern Europe is where it seems like most of the growth may occur, but that's not going to be sufficient to even push the euro area above 1%. There is a view that given less inflationary pressures or more certainty around the drivers of inflation, and those seem to be lower in the euro area, that the ECB may move more quickly, as well as in the UK, move more quickly in terms of interest rate reductions. So on to China, which I alluded to earlier. China is in trouble, right? You see it in terms of the comparison to the 2015 to 2019 period in terms of fixed investment growth, the graphic on the left, whether you're looking at real estate in particular, as we well know, and infrastructure. China has slowed down, right? This is a number that's well below China's sort of previous 2 decades. I've got it in the lower part of the bullet points. You can see there that the 2024 growth rate for China is the slowest expansion in over 30 years outside of the COVID period. So at this 4.5% growth rate, which may be slightly higher as we saw recent numbers coming through. So again, that's the slight adjustment we're seeing. I don't see a massive deviation in the updates that are coming through, even for the US economy that the IMF released yesterday or day before. This is still well below, the engine of global growth that we saw for 30 years that China was. So China is in serious trouble. A lot of it has to do with the downturn in the property sector. We all know what's happened with runaway debt in the property sector. That's resulted in massive pullback in real estate. Real estate investment has contracted, and of course, as a consequence, infrastructure investment has slowed down, and that then has fed through into lower growth rates. You've also got private consumption expenditure that is weak, right? There's declining confidence in the Chinese economy. Youth unemployment rates are spiking. Job growth has slowed down. And so suddenly the domestic economy and domestic Chinese consumers are not as expansionary, if you like, in the spending as they were in the past. That then must be coupled with a weak global economy. So of course, part of China's growth trajectory has been built on rising export or export-oriented growth. And so weak global demand, right, has weighed on growth as well in China. So the authorities are not doing nothing. They are looking at stimulus measures, right, lowering interest rates, re-looking at deposit requirements for property purchase so you can kickstart the housing market, particularly for first-time homeowners. Government debt issuance was expanded also to support spending. It's not clear if these are going to be enough. There's a strong tilt from Xi Jinping to look at industrial policy, so that's coming through on fiscal measures, support for high-tech industries and manufacturing in particular. The jury's out, right? The jury's out in terms of whether such active, fiscally led industrial policy will deliver the growth that China requires. As I said, you've got this sort of weak external demand, and I'll talk a little bit later that continues and in particularly biased towards outward-oriented economies like China. So if you've got weak global demand, that's going to weigh on domestic growth for outward-oriented economies. I will talk a little bit later about this notion of trade fragmentation and what trade wars in particular mean for China. And the trade wars are, as you know, between China and the US. So if we move on to the regional outlook for emerging markets, so I'm just taking my time. Growth. So what I've done here is if you look at the two right bars, so I've repeated some of the numbers so you can just see emerging markets are still generally slower than China on average in terms of this graphic here, where I've separated credit ratings. So in particular, emerging markets that have weaker credit ratings will grow slower. So the idea that growth is actually in the emerging markets going to be pinned or very strongly correlated with credit ratings is a really important view, right? So if any of you are looking at emerging market growth rates, I would first check credit ratings of those economies, and those tend to be a strong predictor for projected growth rates. But in particular, we isolate India, right? So India's economy has shown resilience, which may bode well for Modi's re-election, although that's still on hold in terms of South India being the swing vote, as it were. But the India-China comparison, not to do too much of a deep dive into it, is a lot to do with demographics. China has seen a demographic turning point, whereas India's got a very young population, but also much stronger domestic demand, again, driven by the demographics in India compared to China. And then, of course, all the mistakes that China's made in housing and elsewhere have not occurred in India. So I think that's a really interesting comparison to keep in mind. Just to continue on the emerging markets, if you look at emerging markets and their elevated borrowing costs, those elevated borrowing costs continue to squeeze fiscal space in many emerging markets, right? And so the standard sort of solo growth model derived measure is to compare bond yields, less nominal growth rates, and look at their change. And essentially, those have been increasing in emerging markets, at least over the last 5-6 years. And effectively, what this means that bond yields are leading nominal GDP growth rates. So you're not growing fast enough effectively to pay your debt. That's essentially what it means. And so the idea that you should be focusing on emerging markets compared to, in general, that are divided by investment grade versus non-investment grade emerging markets for growth opportunities is reflected here again. The idea here is you're probably going to see in the medium term, at least, a stalling of relative growth rates in those part of the emerging markets sample that are highly indebted. And so convergence or catching up with advanced economies is less likely in that sample of emerging markets. So a little bit of a technical point, but I think that's really important. So yes, you may see growth opportunities in emerging markets, but please remember, if you are looking to invest in emerging markets outside of South Africa, which you know much better, but just look at the dynamics in those emerging markets. So if we move on to inflation and global inflation in particular, there's a little bit of positive news, which is the sort of emergence from, let's call it the 2 to 3 year pandemic period, and elevated interest rates, which would indicate that across the globe, right, the fight against inflation is being won. I mean, if you wanted the sort of headline result. And the technical version of that in the data, this is data from the IMF, is that 80% of the world's economies are now expected to see lower annual both headline and core inflation in 2024. So, and you see the graphic there, this sort of battle to bring prices down. We are cautiously optimistic that we have reached the point of having won that battle. I think we, if you're a football follower, soccer follower, we sort of I would argue in the last 10 minutes of the game, we're on 80 minutes and there's a little bit of extra time and it's 1-0 at the moment, right? And we're close to winning this, but we're not quite there yet. And why we're not quite there yet, and it struck me when I was preparing for this webinar again, is I want all of you to quite carefully read the second last bullet underlined in bold from the IMF. This is the IMF's view, right? They say, and they said this in January, monetary tightening in advanced economies is concluding, and then look what they add on. But real policy interest rates are expected to remain elevated for some time as inflation returns to target only gradually. And this was said in January amidst the frenzy in December, right, in bond markets and elsewhere, that, interest rates are going to come down by the first quarter. There was this craziness of five adjustments by June. But the IMF, if you read it carefully, right, in its own bland language, was not saying that, right? They were saying inflation is coming down, but they will do so gradually, right? And so I think if we had sort of read this more carefully, we probably, or at least many investors, would not have gotten caught up in the sort of lower interest rates frenzy that gripped markets, I think, in December. The reason for the IMF's caution, I think, right, comes back to the medium-term view, right? That if you had the largest and the fastest increase in US real policy rates since the early 80s, just think about that. This was the largest and the fastest increase in the US economy, interest rates for, what are you looking at, like 40 years, right? You would not expect interest rates to adjust very, very quickly downwards, right, over 2-3 quarters, which was the expectation here. So I think if you took the medium-term view, we probably would be sitting in the IMF's corner. And this is reinforced, right, by the data. If you look at, yes, we are looking at the Fed, but if you look at advanced economies, right, you still have the majority of advanced economies whose inflation rate remains above the target, right? So I think it's just close to half or just over half of inflation targeting emerging markets as well have also got their inflation rates that have not fallen within range. So the idea, and here again is a quote directly, or this was sort of gleaned from various, the IMF, the World Bank, and the OECD, to collectively view that this aggregate figure of advanced economies and emerging markets moving within range is only likely to occur in 2025. So that then again is a slight readjustment of our, when is the Fed going to downwardly adjust interest rates? Is it going to be June? Is it going to be July? It may very well be, but I think the sort of we need to wash away the strong optimism of interest rate cuts that we're sitting with in January. If you look at this data, I'm almost of the view that let's keep looking at the data. Certainly, if you look at the U.S. economy, we haven't reached below 2% yet, even though most of those recent numbers are driven by the supply side. I think if you look at the Fed's language, they haven't said anything more aggressive about rate cuts. So the point I'm making is if you look at this data here, it almost confirms that the trend is towards moving within the inflationary range only in 2025. So yes, though, the positive is we are expecting, at least based on the data, a soft landing, a softish landing, right? And that for me is a massive success to pin on the sort of jackets of all central bankers, most central bankers in major economies around the world. So that's a huge success of monetary policy, I think, and learning in terms of previous crises. If you look at inflationary expectations, so the direction of change is positive. So remember, most central bankers are not really interested in this number because that's historical data. They're interested in the bottom half on the left, and that's the inflationary expectation. So there is a general trajectory downwards, and I think that's continued even with the more recent Michigan data that we've seen from the US economy. There's also on the supply side of the economy, on the demand side of the economy, supply side of labor, you've got wage growth that seems to be muted. So generally you do worry in these inflationary cycles, right, that long-term contracts, whether it's housing, but in particular wages, right, become ossified, and so you end up in a wage price spiral. That doesn't seem to have occurred, and certainly nominal wage growth numbers seem to have tapered off in most major economies, including major developing markets such as China and Brazil. So I think that's positive. I will talk later about some of the concerns for some of the sort of downside risks, which include labor disruption. But let's hold that for now. If you want to disentangle inflation, we look at goods and services. I think in general, there's been a sharp reduction in goods inflation, both for the US and the euro. And a lot of that has to do with global supply chains basically coming back on stream. We caution there based on regional disruptions, but we'll come back to that. So in essence, the rotation of demand from goods to services has continued as well. So you've got declining goods inflation, right? But services inflation, if you look there at the solid lines, services inflation remains stubborn, right? And I think a lot of that has to do with rental contracts generally, right? And the like that have remained stubbornly high, partly because of the nature of these long-term contracts. So I think that's something that the banks around the world, the Feds, central banks around the world are keeping an eye on. So there is a forecast from the World Bank that says global headline inflation, right, will recede. But I want you to look at that number. It's going to recede from 3.7% in 2024 to 3.4%. right? And it's still above the pre-pandemic levels. So again, if we come away with the view, at least based on the data, that global inflation, the global inflation dragon has been slayed already, I think that's not true. The data doesn't bear it out. And I think, if you go into the intestines of the US inflation numbers, I think that's the sort of residual concern that the Fed sits with before it will make the big decision to reduce rates. So I do want to turn to a little bit of a sort of detailed slide on oil, simply because I think given its importance, right? So recent macro models, there was a piece recently produced, I think it was the World Bank, around inflation volatility in the globe over the last 40 years. And the most important determinant of inflation volatility was the oil price, right? So the oil price becomes a key determinant of how we think about movements in prices globally. The view I would have had is geopolitical tensions, right, in the Middle East, accounting for 1/3 of global seaborne oil trade, which would mean that oil prices by definition will go up this year, right? Except that very careful work from oil experts, particularly at the EIA, indicated something different, right? So what they've done is they've looked at the supply side of oil, right? And they asked the question, are there alternatives, right, outside of the Gulf states and the Middle East for oil supply that may mitigate against regional disruptions? And so putting all those factors together, they come up with a view, right, that the global market for oil looks reasonably well supplied in 2024, which is really interesting, right? That's driven by the view that you've got higher than expected non-OPEC oil production, right? That's coming on stream. And I think the markets are listed there. So it's both the US, Brazil, Guyana, and Canada, right? Will see new significant supplies coming on stream outside of the Middle East. So when they take that into consideration, they mitigate against regional disruptions, right? Now, of course, they may have a ceiling on the contraction that's going to come through, possibly through Middle East disruption-related factors. And based on that, right, their forecast is for relatively little price change, right? And the language is important, based on the expectations that global supply and demand, right, of petroleum liquids will be relatively balanced. So the view here, based on growth in demand for oil and the supply, which is slightly more diverse for 2024, they don't see massive price adjustments in oil. Here's the update point, right? We would have seen with the events in the past week in the region that there was some elevated concern around oil supply, right? So to come back to my subtle point, the escalation of the conflict, right, from the IEA side probably had a ceiling to it, right? Now, if we end up with a full-scale regional war, right, between Iran and Israel, and the entire region gets involved, and I think those probabilities are still low, but if we move to that very quickly, then the escalation of conflict factor in the IEA's model would be much higher. But I think based on where we are now and based on my balance of probabilities, if I look at this IEA number for the year, I think there's enough to suggest that you're not likely to see massive elevation in oil prices. But it'd be wonderful to debate that, because there's one thing where one can be completely wrong. What else is driving inflation, global inflation, that's related to regional conflict is often not appreciated, because we don't think about container costs and we don't think about shipping routes, right? Or unless something big happens, right? And I thought it'd be useful to just sort of outline in two graphs how you think about the World Container Index is one measure that you can use to look at prices of containers and how those fluctuate in US dollars around political events. So I've got the various events from the Hamas attack, the Israel response, the Houthis attacking, and so on, and you can run through the different stages of the conflict, as it were, and the responses. And what's notable is that the real spike occurred with the Houthis attack on the 4th of January, right? And so there were no concerns around shipping routes and so on through the Red Sea right up until the Houthi attack, when you see a massive spike. If we go, the difficulty with this, as is always the case, and I always look for relative measures, that it's difficult to estimate or evaluate how large this is without a comparator period. And so what I do here is that I look at the period that goes slightly back before COVID and include us right through to, let's call it the Houthi events, right? And what you do see, firstly, right, is that on average, the COVID effect was much larger, which is in this period here. I don't have enough time to sort of take you through the details of the data, but you see the COVID World Container Index impact, massive spike. The Houthi attack, right, or the current events have not reached the peak of the COVID effect. That's the first thing. The second thing is the volatility or the sharpness of the response was much higher in the current events relative to the COVID period. So the COVID period, you see a gradual rise in World Container Index prices and then a gradual reduction. Whereas with regional conflicts such as this, that you see high volatility. So as soon as it goes up with the Houthis, it comes down almost within a month. And I think that volatility is likely to continue as events unfold throughout 2024. So just keep in mind that elevated inflation may be short term, but supply side driven through the regional conflicts, regular events that you see, whether another Houthi attack occurs, whether Iran threatens the route as well with the Houthis and so on, you may see again a spike in World Container Index prices. I think it's worth keeping an eye on if you invested in thinking about global inflation. It's worth keeping an eye on almost daily updates in the World Container Index that you're likely to that you can get data on. If I move then to, and I'm aware of the time, global financial developments, we know about monetary tightening that's concluding in advanced economies, and there are moves to ease rates, but those haven't occurred in major economies yet. So, and they're likely to proceed, and I think the language is important, at a measured pace, right? And so one does need to be quite careful about reading too much into Fed statements about the health of the economy and prices coming down and so on. So I think they will move downwards, these rates, but it's gonna take some time. And you saw some of the action, as I said, at the end of last year, right, where yields went through the roof, but they have pulled back, right? But they remain now absolute levels, at levels that will put upward pressure on the cost of capital, right? So I think what we often forget is that in absolute terms, right, the cost of capital for governments and firms remain high. And the volatility, as the expectations around interest rate cuts have come through in the end of last year, is what you saw in long-term yields. I think what's important to keep in mind is that median global government debt has risen by 20 percentage points as a share of GDP since 2007. So I think the idea that you've got a highly indebted fiscal position coming through for the US economy is not unimportant as we think about growth. We've spoken about bankruptcies and delinquencies on the credit card side, and they show in private sector debt service ratios, which have become and risen in China. They have risen significantly in the US. If you look at Those Z scores, so just to be clear, they're defined as the ratio of interest payments plus amortization to income. And you look at how those have increased in the US, but also remain elevated in China. And so that financial strain in China is what's holding back growth. And I think a lot of that financial strain is driven through the property sector. I think what's underemphasized is how much global trade has struggled. So again, the long run view, which is really astounding to me when I read the statistic, is that global trade growth in 2023, and I think 2024 won't be far behind, was the slowest, if you exclude the global recessions, right? And of course, the pandemic, it was the slowest we've seen in 2023 for 50 years, right? So you've got very weak trade growth. You've got a very weak external demand for exports, right? Demand for imports around the world economy. What do the numbers show? World trade growth is projected to grow at about 3.3% in 2024 and then 3.6% in 2025. Again, how high or low is this? Well, the historical average growth rate was 5%, right? So you've got a full sort of 1.5, call it 1.8 percentage point lower growth rate in world trade. World trade is going to be the engine of global growth, right, on the consumption side. Is it partly to do with weak growth? Yes, but also lurking there, and I'll talk to this in the next slide, I think, is rising trade distortions and what is called geoeconomic fragmentation, right? And so that's really a fancy term for trade wars, right? And the data shows it, and I'll show it in the next slide. Countries have imposed about 3,200 new restrictions on trade in 2022, and that goes up to 3,000 in 2023. How high is that? Well, pre-COVID it was 1,100. So you've got like, a sort of a tripling of trade restrictions in a 2-year period relative to the pre-pandemic period being pushed through by countries, right? And I think what that shows, again, trade distortions, right? But it also shows the re-emergence of trade wars and what economists have called, you may have seen the phrase deglobalization, and I think that's where that comes from. And so in many ways, the contribution, as we see in the graphic, right, of different parts of the world economy, so advanced economies and emerging markets to global trade growth was negative in 2023 and turned positive over the next 2 years, but still much, much lower than the 2 decades or the decade 2010 to 2019. So I think just keeping in mind that contraction in global trade is another storyline on the right-hand side that's feeding through these lower growth rates that you see. If you remember from your economics, you've got the C plus I plus G. I'm talking about the X minus M, right? So trade growth. So to continue, right, on the global trade theme, you do see, so what does some of the data show? Services trade is recovering, right, from the pandemic, but, and you can see it here, the pandemic period, right, and the slight recovery here, but the pace has slowed. So you almost see in the data sense here, the sort of increased disposable income that's being dissipated now. And so you've got a much slower recovery in the demand for goods and services that's projected going forward. And just to repeat what I said in the last slide, it's the slowest expansion in the last, if you compare 50-year period outside of the Great Recessions. If you're looking at some of the data points, global trade contracted last year, reflecting these declines in the key advanced economies. That's when those in that bar graph in the previous slide, and EMs themselves have decelerated. You are seeing slow expansion being projected. So that's this figure here. You're going to see a slow expansion coming into next year. but the contribution of services won't be as large as it was in the past, right? And I think that's aligning more closely with the trade composition patterns that you observed before the pandemic. So it's almost like we had this elevated trade in services as people wanted to travel and so on, and that's now come back into line as we reset the economy to a post-pandemic world. The responsiveness of global trade to global output, it's expected to remain lower than before the pandemic, right? And so a lot of that is to do with our investment growth story. So you're seeing less and less contribution from trade. And investment, as the data always shows, tend to be more trade intensive than other types of expenditure. And so if investment's slowing down because of elevated interest rates, the kick through trade on growth will be lower. There is some expectation that tourism and tourist arrivals will pick up in 2024. If I do a quick deep dive, as I've called it, into commodities markets, we've spoken about oil prices. I'll leave it for now, but metals prices are set to decline, and metals generally are to do with China and global growth, and China's slower growth is effectively going to weigh negatively on metals prices. Just look at that number. China accounts for 60% of global metal consumption. It's not something we can control, but if there ever was sort of a case for too large a dependence in the world economy on two economies, this would be it, right? If China and the US do badly, we will struggle, and China is struggling dramatically, right? It's not all bad news. So some of the metal prices projections suggest a pickup in 2025 with the idea that China's property sector will stabilize. So that's assuming there's no bigger blowout than we've already seen. But crucially, the demand for metals used in the green transition, right, copper and nickel, should increase. And I think that's going to be coming through from the EU and the US, where there's pressure for greener products. The point being made, as I said earlier, is that you may have this elevated prices in metal going forward, but that's contingent on the green energy demand story, which I think is fine. But if it's contingent on the property sector issues being resolved in China, and that's not clear. The one positive news is food prices are expected to decline quite dramatically, and that would be agriculture here. So they're going to remain muted over the period. And I think that speaks well to this overall decline in headline inflation. So for natural gas and coal prices, those declined in Europe in 2023 because of reduced energy demand and high storage capacity in gas. You're expecting natural gas prices to fall further 2024 and 2025. But again, your upside risk to gas prices sit with what's happening in the region, in the Middle East, and weather patterns in Europe, where you may then again see elevated gas prices. Food prices, as I said, fell dramatically, and it's 9% in 2023. There was the exception in rice that is getting to a little bit of the intestines of food prices. But again, it's about trade restrictions. So rice rose in price by 27%, and this was because restrictions on the exports of non-basmati rice from India, right? And so you can again see how protective measures from countries can flow through into prices. The expectation, though, on average, is for food prices to decline, right, in the aggregate, right? But what are the risks? And you know them well, right? The risks are increases in energy costs, right? So if suddenly the Ukrainian war picks up, oil prices pick up, there you go, right? That changes the outlook for food prices. Adverse weather conditions are massive, right? So if you've got exogenous shocks in weather anywhere around the world for a source of a product that we haven't even thought about, anything from cucumbers through to citrus fruits, right through to grains, where we're not thinking about weather patterns that are localized, those can and will feed through to price changes. And I think that's something, the idiosyncratic risk there is massive, I think. One thinks of floods and so on. Uh, Trade restrictions are not going away. So again, as we saw with basmati rice, that can affect food prices. And then, of course, you've got the geopolitical uncertainty in one of the grain baskets of the world, in the Ukraine. Um, there are longer term risks, but and that's the broader effect of climate change and these biofuel mandates. I do, though, want to just give you a little bit of a window as we move from inflation to the real economy to what, if we're talking about the US economy, what is the quick outlook in terms of sectoral growth patterns? And this is data from the US Department of Labor. Again, we don't often spend enough time um, doing our independent work, I don't think, from actual data that's produced by the US. And that's what I've tried to do here. This is their projection over the last decade, right, of industries. Sorry, this is the actual data of industries that had the fastest growing and most declining output levels. And the next graph will be employment levels, right? And essentially, it talks to the story that you see on Wall Street and NASDAQ, basically that the information sector, right? So think of this as the big tech stocks have driven growth. And in essence, what they've dryly called information, and they've got software and software publishers and so on. These are all the FANG guys are sitting in here. That's where you've seen the red dots are the largest levels of output growth, right? Where you've seen massive contraction is in federal government and a little bit of deindustrialization in manufacturing. What about employment, and in particular wage employment, right? Construction added a significant number of jobs, but a lot of the jobs growth was led by healthcare and home healthcare services. This is an aging population, an advanced economy that now has lots of old people. And so demands for these types of services have fueled employment growth. You've still got employment growth elsewhere, but the largest increases sit in these services sectors. And I think that's a really important point about where US jobs are being created. Jobs are being lost in manufacturing, and that's essentially because of the previous graph. Most of those jobs in manufacturing are being replaced by machines and technology. So now I want to turn, as I know we run out of time and I lose your interest. I've been going for an hour already. I want to turn to downside risks, which partly feed through to the earlier slides. So in other words, you'll see some of the themes have come out already, and I'll turn to some of them sequentially now in the downside risks. The most obvious is around conflict and geopolitical risks. Now, I put the graphic on the left because I do want a sense of, again, relative effects, right? So this is data on what is called a geopolitical risk index. So these are academics, Caldara and Iacovello, who have compiled this geopolitical risk index, right? And looked at the scale of each of these events over time. And it's important to keep in mind that at least over the last 2 decades, the 9/11 attacks, right, are the comparator, if you like, in terms of the highest geopolitical risk index or conflict index number that we have. And in comparison, the latest conflict that we're seeing currently is right at the end here. So I think the relative risk ratio is important, but they, at least in terms of other conflicts, but if you compare the geopolitical risk index over the last 5 years, this has been a significant spike, right, in an escalation and risk index sense. So what do we know? Of course, we know that the conflict will have an effect on commodity prices. So far, they've been muted, right? Historical evidence would indicate that escalation could lead to significant oil supply disruptions. We know that, and large spikes in commodity prices, especially if the major oil producers become embroiled. So I think in a data world where oil price fluctuations econometrically, right, have been shown to be the dominant driver, as I said earlier, of inflation volatility over the last 50 years, this matters a lot, right? But wars can also reduce the global supply capacity, right, by diverting international trade and capital flows and disrupting supply chains. So it's the knock-on effects, right, from oil prices through to shipping routes and so on, that you have to keep an eye on. Just remember as a note that the region, so the Middle East produces about 35% of the world's oil exports, right, and 14% of its gas exports. So there's a weighting dependence there, that's really important. What's perhaps less appreciated as we focus on the Red Sea, you saw the container costs, 11% of global trade flows go through the Red Sea. It's not just oil that comes through the Red Sea, right? So there is a view, a sort of narrow economic view, that if you've got debt finance, military spending, that may offset these negative effects on the supply chain disruptions and so on in the short term. But they are diversionary. I don't think the kickstart from debt finance, military spending is sufficient. The other area of conflict, as we focus on the Middle East and to some extent the Ukraine, that we should keep an eye on is the conflict between China and Taiwan. I think I've argued before, if you, on the balance of evidence, particularly Xi Jinping looking at what's happened to, even though he's got a very strong view on Taiwan, he's probably looked at Ukraine and realized, okay, this is riskier than I thought. And I think if you look at his calculus, the risk of a all-out war is unlikely between China and Taiwan, right? But there are always risk-related events, right? So you've often will see Chinese military drills near Taiwan. As we always say, those kind of drills and those kind of, if you think of the Iranian calculated strike, there's always a room for error, right? And if there is a mistake in a drill by China or by the US, for example, this can spiral very quickly. So that's what always has to keep in mind. Taiwan, of course, has an opposition party now in power that's truly anti-unification. And if you do face a large-scale conflict, remember, this is the semiconductor industry. It's immediately cut off, right? So that's the location being Taiwan, despite the US attempts to create alternative supply. It's basically Taiwan. And once you have this cross-strait war, you're drawing in the US, not just the US, but Australia, possibly Japan and South Korea, and essentially you've got contagion effects there. China could then respond if one thinks through that. Even if there's a miscalculation, China could use the instrument that it has in its toolbox, which is trade war, and so it could start blocking the exports of raw materials and goods, particularly rare earths, which are needed for the green energy transition. So there's all sorts of things on the China-Taiwan front that you've got to keep in mind. A second downside risk, which we're living through arguably, is weaker growth in China, right? So as long as China keeps in that 4 or 5%, we're sitting in the sort of 24, 25 projections. But I think if you see a fall off in China, incidentally, we've seen a recent update in China where growth rates were higher. So I think we may be moving in the right direction. Time will tell whether the sort of kickstart from Xi Jinping through state industrial policy that kickstarted growth is going to be sustainable or not. So why are we worried? I mean, most of you will know this, but if you just look at the figure on the left, China's share of global commodities consumption alone, not just oil and natural gas, but in particular coal and metals, right? You begin to see how it's such an important source of demand for these commodities. But it's also a major consumer of commodities that are central to the green energy transition, right? So as if you're looking at solar panels and so on that are produced in China, right? Those items would require inputs such as metals and the like. So we do face the China contagion, right? So if you've got contraction in China, you then further contraction beyond the projections that you see, you're definitely going to see significant downward revisions to global growth expectations, right? And I think the sort of outweighing of a lower growth in China in terms of our growth models is built in. And I think that's something to keep an eye on. The other thing that's perhaps less appreciated is China's, of course, particularly in Africa, but elsewhere, turned into a significant bilateral creditor to many emerging markets, right? And if that starts unwinding, you've got significant adverse spillover effects, I think part of which you're already seeing in key economies in Africa, right? In Ghana in particular, Mozambique, Ethiopia, and so on. So the sovereign debt risk that's built in from a weak China is really important as a contagion effect that I think we don't appreciate outside of the major economies. So the question then is, the Chinese government, are they going to opt for a big bang stimulus, right, rather than these sort of subtle levers, right, through monetary easing or bespoken curtailed property bailouts, right, easing housing purchase restrictions, particularly for those living in cities, right? Those will be smaller measures, or are they going to go for the big bang, right, of a massive stimulus? So it's an interesting view that there's the public criticism that's growing in China might push the Chinese Communist Party to reduce its support for the market economy and come in as a sort of popular mandate, right, with rent controls and sort of guaranteed jobs for life and so on. So those are direct sort of state interventions, and it'd be interesting to see which way Xi Jinping moves. Certainly, he is a leader who believes in state control. He believes that markets need to be moderated, but at the same time, he does believe in a sort of a dominant economic China, right? So China that's growing fast and is a high-income country. So it's an interesting balance for him. Of course, the big downside risk that lurks and will lurk throughout the quarters for the year is, are we going to be higher for longer? Now, if I presented this late last year, we would have all said, well, that's a low risk. We're probably going to see interest rate cuts in March. Well, those haven't happened, and we listen to the IMF and we take their view literally. If I could be so bold, you would say, yes, we are higher for longer, and we're only looking at rate cuts next year. I'm not saying that's the case, but the pure modeling from the IMF in a literal sense may, without new data, may have suggested, well, actually looking at the last quarter only. So the scenario where inflation remains stickier, right, and higher, so above, let's call it the US 2% threshold, is there. We've said it's a low probability, but it's certainly still above the 2% as we speak right now, right? What does that do? Slower disinflation, renewed upward pressures from energy prices may be a key reason that comes through again, right? And that's, you're seeing elevated oil prices that possibly push us away from the 2%, right? You've got labor markets that don't want to slow down, right? What it means, of course, is that the central bank pulls back. Central banks around the world pull back, and they're less willing to lower interest rates. And then the follow through with growth is obvious. So I think we had a really interesting juncture, right, where the path to lower inflation is less clear than it was at the beginning of the year, where there was a lot of optimism. And I think that's something definitely to keep an eye on. So again, I've raised this as a concern, and as I said, I'll show you data on this. There is definitely trade fragmentation, trade restrictions, deglobalization, whatever you want to call it, that's grown in the world economy. Now, I gave you that number about trade restrictions, and I'm showing you a graphic here, right? So harmful trade restrictions is what we're after, and the harmful growth rate effect is what we're after. And you see, over the last decade or 2 decades, there's been very little, right, in terms of harmful trade restrictions, but suddenly they've spiked. They have come down, but they're still much higher than they've been for the last 2 decades. So pre-COVID. So in essence, we're entering a world which, if we wanted in a sort of simplistic way, I want to think of it as the great China-US trade war, is very much about economies thinking back to, well, trade restrictions, job protection on companies at home, less interested in free trade and so on. Ironically, that's happened at a point when economies around the world are far more interdependent than they've ever been, right? What does the evidence show? Some really interesting academic work shows that um, uh, uh, that as the US, right, increases tariffs, right, on Chinese imports, right, there needs to be a replacement, right? So if you've increased tariffs, China now has to find access to markets elsewhere, or the products are still in demand, right? The countries that expanded their market share in the US also strengthened their trade ties with China. So just think about that. So if suddenly the product A that I was getting, the plastic toy I was getting, or whatever it was from China, is now coming from Mexico, it turns out the data shows that Mexico's trade ties with China has actually increased. And turns out, it shows up in the data, the primary objective of reducing US economic dependence on China actually has not been realized, right? In fact, what's tended to happen is higher prices of import goods for US consumers, right? Because of the length and complexity of supply chains, right? Secondly, not shown here, but in the previous, the second bullet point is that those indirect routes to market in the US have seen those economies like a Mexico and so on actually strengthen their ties with China. So in fact, China may be sitting behind those economies that are supplying the US. And effectively, the US's attempt at friendshoring, nearshoring, onshoring, and so on, motivated by trying to reduce dependence on China and geopolitical tensions and so on, will effectively, and the early evidence shows, right, effectively will see increased prices for US consumers. So we're back to the sort of free trade story of free trade will always increase the welfare of domestic consumers. And you're seeing that played out in the trade war. But the point here is with trade fragmentation, with increased restrictions come increased prices, reduced demand, bad for growth, right? That's beside the sort of overall geopolitical tensions that trade fragmentation feed through into. So here's an interesting one of mine, which is if you put the two together, which is global trade war and green energy, you've got a toxic downside risk that I think hasn't been appreciated enough. So how do we think about this? So just, the graphic on the left is really important. You've got the top three critical mining, what I call critical minerals, right, for either the green energy or core needs in an economy. Those, the country of origin. And you'll see the blue bars for some of them, graphite and rare earths. Let's be clear, rare earths are absolutely critical for the move to green energy or the move to green economies, right? Rare earths are absolutely critical. They're called rare earths because they very seldom occur in large deposits. They're in deposits all around the world, but their large deposits concentration sits in China, all right? So China effectively becomes the key supplier for the key commodity and the key input to the green transition, right? So you can imagine, effectively, green energy needs meets the possibility of a global trade war, right? Because not only is China the key supplier in the blue, right? It's also one of the key minerals processing countries on key minerals such as cobalt, lithium, graphite, rare earths, and copper. So here we sit, right? You've got these green energy or clean energy or initiatives in the EU and in the US that are being legislated as everybody tries to move to net zero in terms of emissions, right? But the key supplier for these inputs to get you there is China. And so if you are engaging in excessive trade wars with China, as the US and potentially as the EU, China has the right of refusal to supply these inputs, right? And so for me, that's something just to keep in mind as a significant downside risk. And of course, you can up the ante, you can increase the price, you can simply refuse to supply these rare earths or the inputs, you can delay the supply of it. There are all sorts of instruments in this trade war that we likely or could see should China wish to respond in kind. Of course, the one key risk that we always sort of keep in the back of our mind as we think about markets as economists, particularly if we're not sort of climate change specialists, um, is the massive risk of climate change shocks. And I think, if you think of food prices, if we think of the impact on cost of living, if we think of the impact on financial markets, this is a massive downside risk, right? So I've given you sort of this is again, another academic estimate of temperature movements and anomalies, right? And note the starting date. This is from 1850. Nothing looks interesting until you look at last year, right, where we had the highest um, temperature recorded on average ever, right? Since we've been collecting these data from the 1800s. So what that means, though, right, apart from the temperature spiking, I don't need to tell all of you on this call here, is the probability of extreme weather events increases, right? So you're really living through this, whether it's severe droughts, heat waves, sudden floods, but those weigh on things like crop yields, right? Those yield on a whole range of industries, right? That are either commodity dependent, whether it's manufacturing, whether it's agriculture, mining. So the entire value chain in an economy becomes affected by these weather events. These costs then filter through and they spill over to households. And of course, then you've got concerns around cost of living and food security and so on. This is all amplified by a fiscal space that's closed down. So suddenly, if you have an excessive weather event, government is less able to respond to them because of their fiscal capacity. There's also the risk to stability of the banking sector, right? Through either loan collateral that starts becoming compromised, and you've got an increase in non-performing loans, right? I think more importantly, the financial sector is now facing balance sheet risks, right? From this green transition as they sit with these stranded assets, particularly if you look at property, for example, where EU standards have moved to green property standards, and brown property or dirty property, if you like, that has too many air conditioners and so on, is suddenly a stranded asset sitting on the balance sheets of banks and other financial institutions. And that's a massive risk. I think there's also a massive risk to insurance providers who haven't priced in because they don't have adequate data to predict at a micro level extreme events. And so the kind of impact on insurance, the insurance industry also needs to be factored in. I'm almost done for those of you that are still with us. Industrial action, I think, remains a risk as wage moderation stays where it is. You may find, and we did see early on, right? Small-scale protests in Europe, in the US. You saw it in South Korea, and you may have seen it, of course, in Argentina. So some of those have bubbled already. They've slowed down recently, but I think industrial action is a likely event in large public sector type economies. The UK, for example, there's threat of strikes in public transport and so on. I think that poses a significant risk. The impact the economist predicts is moderate. But I think if you start feeding through the impact of industrial action on supply chain disruptions, right, then you start seeing effects becoming more contagion-like. So I think coordinated large-scale strikes in, as I said, sort of big sectors, whether it's auto, key services in the UK, as I said, railways are already being affected in the UK, as far as I understand. Those could paralyze not just the public service provisioning, but also have an impact on global growth. So as my last slide, you have to be positive. So I've got some upside opportunities. I think, we do see inflationary expectations coming down. So there is a decline, as we showed in one of the earlier graphs. Perhaps that leads to faster disinflation. We haven't seen that yet, right? So I'm not as positive about this as I was possibly in January. Of course, if you see that, it's an easy win then for the Fed and others to move with lower rates, and then a rising tide will raise all boats. The other upside opportunity is the slower than assumed withdrawal of fiscal support, right? So you may see, if governments kick in, even if you look at South Africa, if we kick in with higher growth figures, or in the South African case, infrastructure gets turned around, governments may be more willing to hold on to fiscal deficits, right? So put it differently, they might withdraw fiscal policy support more slowly, right, than they had anticipated, on the back of better growth figures and therefore better revenue. The third upside is, of course, China starts turning around, right? So we've seen this uptick, a really important number. China's growth rate comes in higher than expected. We don't know if that's short run or not. We don't know if the property market's going to be resolved, but if it is, and it moves quickly, the Chinese authorities are known to move quickly on problems they have and move decisively. If they get it right and China recovers, then it's happy days, right? It's happy days for the resources sector. It's good news for global growth. The final one is probably the one we think about the most, but is really important for productivity-driven growth, is the role of technology. Now, you've all heard about AI and the impact of all sorts of new tools, but I think the key impact, right, is the boost on both worker and firm productivity levels, right? And the harnessing of AI to create not just new markets, but at the intensive margin to increase productivity levels of workers, means that it can positively impact on growth. So with that, I'm going to stop, and I hope the slightly delayed presentation has given you a little bit more food for thought, and has also allowed us to look back at economists who claim certainty at the beginning of the year, and suddenly we've forgotten what they actually told us. And so we can start seeing some of this stress testing of initial predictions. If I could just take a few minutes before we conclude to try and answer some of the questions that have arisen. So the question from, I think it's Chuck Miller: China growth of 4.6% would be most welcome for most countries. So is it so bad? So Chuck, the reason it's bad is because we want 8% from China. We'd love 3% as South Africa, but 4.6% is much lower, as I said, than it's been for 2 decades in China. So we need China to be growing at 8 to 10%, and I think that's the big challenge. Another question is declining demographics in China. Some counter that automation will offset this, with China employing many multiples of the number of robots relative to the developed markets. Yes, sure. I think so. You get the productivity kick, as in with AI. So this last slide that you're looking at is what China. So China is the leader, right, in adoption of robotics, and it's the largest purchaser of robotics in the world. That's the productivity kick you're getting from technology. The concern we have is on the consumption side, in part, right? So when demographics change, younger consumers that are coming on stream will generally be your impetus for consumption, right? China's at the early stages of a demographic turning point. So I think it's not a massive factor. It changes the nature of consumption, right? So it moves away from, let's call it, goods and services of a particular type, software, televisions, and so on, to ones of another type, like health services and so on. And I think that's the change that you're seeing. But China's got a bigger problem at the moment, which is a contraction in consumption demand generally. So there are a few questions. Demand for gold and platinum. So gold will generally move in the opposite direction of growth forecasts. As people get nervy about paper money, gold demand goes up. There's a lot of demand for gold for personal use in countries where, such as India, for example. demand for platinum, again, coming from major producers of vehicles, right, for catalytic converters. So if you just look at that sort of profile of countries, tends to be China again, but also in South America, you'll find platinum demand driven by where the product is being made. Yes, El Nino will continue to impact crop output in 2024 before it dissipates. There's no question about that. The scale, I think it's from Christopher Gilmore, the scale is what you're after. So you're looking at the scale of the impact and whether it's going to kickstart, whether it's going to hike food prices and crop outputs significantly and sustainably, if you like, across regions. Okay. So there is a question about how badly would a potential war between Israel and Iran affect markets globally or locally. I think if there is a all-out and full-scale war, then I think we're in a complete, that's the sort of 5% probability extreme event. And I think that's the extreme event, because then it becomes almost by policy, the US gets involved and it becomes a regional war. And I think there's a low probability, but I think if it does happen, then all bets are off in terms of our growth projections and so on. We almost have to redo this presentation and say, okay, well, what do the numbers look like? Because all of them will start moving in the wrong direction. Yes, so Brian has a great indirect comment. He said, I see that inflation has dropped to 5.3% in March from 5.6% in February. So that's a really important point, because yes, it has dropped. The question for the Reserve Bank and the MPC is that enough? And if you think of our inflation targeting range, the argument would be it hasn't moved down significantly enough for the Reserve Bank to consider a rates cut. And that's almost analogous to what's happening at the Fed at the moment. And there's a question from Shainol. Do you believe South Africa will continue to lag, or do you see any positive trends that could boost local growth? Too early to tell. I think, the thing we're looking for, Shainol, to be honest, is a change in infrastructure provision. So if there's a turnaround in Transnet, in energy, fixing in water and so on, all amidst an election, then maybe. But at the moment, I don't see any lift from growth aside from a resources run if China turns and so on, and then we get an external positive impact. Okay, I think that I will. There are lots of other questions coming in, but we're probably running out of time. There are interesting questions about Bitcoin versus gold, so I'm not going to give any investment advice here. Sorry, I'm just reading one more question. Yeah, so Deirdre has asked, elections around the world affecting growth. I think elections, depending on, everything from the sort of the reliability of the elections, as long as there's no disruption and so on, which I think is fine in the South Africa case, that's not an issue, but right through to whoever wins, right? So in other words, if we see an ANC EFF election, I think we're going to see huge disruption in markets and the rand weakening and so on, right? But if we see the ANC come into power with no interesting eyebrow-raising election partner, I think we carry on as we were. Not to say that's good, but it's just, it's neutral almost. But I think, as you've seen in Argentina, there are big concerns around economic growth because of who won the election. So I think they can make an impact. I think in the case of the US, if Trump comes to power versus Biden, there are all sorts of probabilities around what it will mean for policies. But in general, I think if you look at if you look at Trump versus Biden in terms of previous policies, Trump is more than likely to be pushing for tax reductions and so on. And so Wall Street and stocks would actually look kindly on a Trump victory. Okay. think we've run out of questions, so I will stop there. And I want to thank everybody for attending the webinar. And I believe that the slide deck will be made available to you and the recording as well. So thank you very much, everybody. Thanks for attending.